Well, according to our next guest, oil will likely fall to the low $60 a barrel range, levels last seen in 2021. That's as markets remain oversupplied. Joining us now is Vikas Dwivedi, Macquarie Group Global Energy Strategist. It is good to see you. So let's get into these forecasts. Vikas, you have clients. They're asking you, listen, where oil is today, where it is 12 months from now. What are you telling them?
Yeah, look. What we tell them is that there's no way to avoid the geopolitical events that are, hitting the market from every direction, whether it's, Venezuela and Iran and Russia oil potentially being taken off the market. Obviously, that would make things more bullish, or demand getting hit from a potential trade war. And if not a trade war, then just tariffs, hurting demand. So those items are all so big that they're dominating the discussions in oil. Where we think it is right now, look, we don't think it's that far off of fair value right this minute, given the uncertainties about some of the areas that could get their oil supply reduced or exports reduced in Russia's case. But we do think, to your initial comment, as time goes on this year and especially next year, we're just in a world of far too much oil supply. There's just no way to get around that unless OPEC cuts even more, right? And I don't think they want to cut more than they've already cut. I think they would, but not much.
So is it, Vikas, is it fair to say, because you write about, and the kind of dynamics, you put it like this, it's a tug of war, you say, between sanctions and tariffs. Is that how investors should think of it?
Yeah. Look, depending on how big the tariffs end up becoming, they could materially hurt oil demand. They could reduce oil demand growth by 25 or even 50% of the roughly 1.2 million barrels a day that we expect to grow this year. So, obviously that would hurt prices in a meaningful way. But in a situation where a significant amount of Russian barrels are taken off the market and Iran as well, you could end up losing as much as 3 million barrels a day of demand. Of supply from just those two countries. Add in a little bit of Venezuela and you get over 3 million of supply loss. That would take the market up to extremely high levels. And I don't think that's something, the Trump administration wants to add on to all the economic uncertainty, they're dealing with right now.
Vikas, how about China? I'm curious how China plays into your outlook looking ahead, because there's folks who point out to, or, what they would describe as, potential green shoots for China's economy.
Yeah, look, we've been waiting for those, and we're not seeing them. A lot of our channel checks with, a lot of people in China that we know well in the petroleum industry, same thing. Like, we're not seeing those green shoots. We're not hearing about them. They may yet arrive, right? The latest stimulus effort is aggressive. It just has to translate into petroleum demand for what we care about, right? And there's a chance that they get better economic activity, but it doesn't translate to petroleum activity. I'll give you an example. One quirky thing is they have effectively their own cash for clunkers program in the stimulus, but that would accelerate the adoption of electric vehicles. You turn in your old combustion engine car and you have a lot of incentives to buy an EV. So in that regard, the stimulus would actually hurt demand. So these are the kind of things that could be negative surprises, even though broadly, the stimulus could be beneficial for China's economy.
Let's talk geopolitics for a second, too, Vikas. I'm just curious. Let's say there is a deal brokered between Ukraine and Russia, Vikas. Let's say you get a ceasefire signed. What would that mean for your outlook?
I think it would probably erase anywhere from $3 to $4 of risk premium that's in the price of oil. As a result of the potential of a supply hit. And after that, I think it would start to get even more bearish because the Russian oil would, I think a lot of the sanctions, the price caps, things that are frictionally reducing its availability would go down and the market could transact and have access to Russian oil more freely. And then the second step is they could probably start growing their production again. They're down about 500,000 a day, and they could probably get that back, especially if Western technology is allowed to work in the Russian oil sector again. As a function of a ceasefire with some visibility on ending the war, right? Not just a temporary ceasefire.
And a final question, Vikas, just top of mind, another geopolitical one. President Trump, Vikas, when he talks Iran, I mean, he does talk tough. I mean, even this week, his comments on social media. I'm curious, just as an oil analyst, you see those comments. How do you think about that dynamic?
Yeah, we take it seriously. We've noticed the market isn't taking the Russian sanctions as seriously as maybe they should. Even though we're bearish, we don't want to ignore that as a risk to the upside. I do think the Iranian, our rhetoric and our positioning should be taken very seriously. Like there's a chance that this overflows into an escalated military situation. And then we think there's no way oil can't rally, right? That's just too much oil that's produced and exported by Iran, or that could be in harm's way logistically, right? From blockades, vessels getting hit, that type of thing would be factored into the price of oil very quickly. If the military escalation ends up matching what I think is the current rhetoric, to the point of your question.
A lot of moving parts. Vikas, thanks so much for your time today. Appreciate it.
All right. Thank you for having me.